Welcome to the Pro Ticker Deep Dive.
You're here because you need to get smart on a complex topic and you need to do it fast.
Exactly. We've done the reading for you, the research, the market analysis, and our whole mission here is to pull out the critical insights you need.
And today we are talking about a market that has been, well, locked in a deep freeze for the better part of 3 years. That's the biotech capital markets.
The deep freeze is right. Since 2022, the capital, which is really the fuel for all innovation in this sector, has just been brutally shut off.
It's been a tough run. Our sources really paint this stark picture of promising startups just gathering dust, unable to raise money.
And that whole engine of wealth creation, the path from a scientific breakthrough to becoming a public company, it just seized up.
But here's the hook for today's deep dive. The ice is cracking. As we close out 2025, the market is finally moving again.
And it's not just a feeling. We have concrete signals. Take Billion2. This molecular diagnostics company pulled off a massive, a $314 million IPO in November.
Yeah, a huge number. To give you some perspective, that was the largest biotech IPO we'd seen in almost 2 years.
And right on its heels, you have In Silico Medicine completing a nearly $300 million listing in Hong Kong.
And that one's really interesting because it specifically validates the investor appetite for AI-driven drug discovery platforms.
So that's the core question we're tackling, right? Is this just a temporary blip? A couple of big companies sneaking through an open window?
Or is this a real, sustainable, structural change? Is the funding environment fundamentally different now?
To figure that out, we have to rewind. We have to look at what caused the freeze in the first place.
Yeah, let's ground ourselves in that recent history because it was a wild ride.
We pretty much have to call it the golden age, right? That period from 2020 to mid-2021. What a perfect storm.
It really was almost unsustainable. You had 3 massive tailwinds all converging at once.
You had the pandemic, which obviously fueled huge interest in life sciences.
Right. Then you had 0 interest rates, which made venture capital incredibly cheap, basically free money.
And a ton of retail enthusiasm on top of that.
You put all that together, and our sources say over 60 biotech companies went public in 2021 alone.
60. It was a gold rush. It felt like any company with a promising, phase 0 trial could get listed.
And then the music just stopped. Abruptly. Late 2021 going into 2022.
That's when the Federal Reserve started signaling those aggressive rate hikes. And this is where it gets really, really painful for biotech.
It's all about the time horizon. It's so important to understand this. Biotech companies are inherently long-term bets.
Right. You're not looking for profit next quarter.
Not at all. You're discounting cash flows that might not even show up for 15 years after a drug gets approved and hits the market.
So when the Fed raises the discount rate,
the current value of that future money just plummets. It's a valuation killer.
And that's the mechanism of the crash.
Precisely. That's why the NASDAQ Biotechnology Index fell over 40% from its peak. For 3 years, high rates were an anchor on valuations, keeping the public markets shut.
Okay, so if that's what caused the freeze, what's different now? What's driving this thaw in 2025?
Well, the number one thing is just macroeconomic normalization. That aggressive hiking cycle is over.
So rates have settled.
Yeah, Treasury yields seem to have settled into a range, maybe 3.5% to 4.5%. And that's a kind of sweet spot.
It's not 0, but it's not punitive anymore.
Exactly. The valuation math for a company with revenue projected for, say, 2035 suddenly becomes palatable again for investors.
And beyond the cost of capital, we're also seeing some serious policy tailwinds helping out.
Absolutely. The incoming administration is signaling strong support for clearer, faster drug approval timelines.
Which investors love. It reduces uncertainty.
It totally reduces uncertainty, and it shortens the path to market that immediately attracts more capital.
And then you have these 2 massive, unstoppable forces, demographics and innovation. The global population is aging, so demand is just relentless.
And what's so fascinating is how innovation is meeting that demand while also de-risking the business. You see AI-enabled drug discovery, for instance.
How big of a deal is that, really?
It's measured in billions. If AI helps you kill a bad drug candidate in phase 1 instead of a hugely expensive phase 3 trial, that is a colossal saving of time and capital.
And that's before you even get to things like gene therapy becoming standard of care or the huge market unlocked by new obesity drugs.
These are fundamental long-term drivers. They support a recovery no matter what rates do in the short term.
Okay, so the macro picture is clearing up. The thaw is real, But, and this is a big but, it's not a wide open floodgate for everyone.
And that brings us to the core thesis of this deep dive. The market is now operating at two speeds.
A bifurcation.
This is the single most important takeaway for anyone in this space. The reopening is incredibly selective.
You can see it so clearly in the IPO numbers. The quantity is not back. Our data shows 2025 is on track for what, maybe 21 or 22 IPOs?
Yeah, that's less than half the pre-pandemic average of 40 or 50 a year.
But the quality, or maybe the size of the companies getting out is spectacular.
They're institutional scale. The average IPO size in 2025 is substantially larger than in the last couple of years. This is hard proof that the bar to go public has been permanently raised.
You have to be more mature, closer to commercialization.
Much larger, much more de-risked.
And the success stories like Billion 10, they reflect that high bar. It wasn't just great science.
No, their IPO was validated because they already had an established position in the non-invasive prenatal testing market.
Which is a massive market. And they're expanding into liquid biopsy for oncology.
Exactly. For listeners, liquid biopsy is a game changer. It means testing for cancer with a simple blood draw. Billion Ton is in a $25+ billion market with a proven product.
So they have clear commercial viability.
Right. And in silico, on the other hand, it validates the appetite for platforms. If you have an AI platform that can make the whole drug discovery process faster and cheaper, sophisticated capital will pay up for that.
Okay, let's track this selectivity into the VC world. That's the engine that feeds the IPO pipeline.
So VC funding hit lows earlier in the year, Q2 2025, but it has stabilized. The real story is where the money is going.
And the data shows extreme concentration in mature companies. Series C and later stage funding actually went up in 2025.
That's institutional capital, flocking to companies with proven traction, late-stage trials, experienced teams. They're backing the near winners.
But here's the warning sign. The canary in the coal mine.
Yes, Series A funding.
It's down roughly 35% from 2024 levels.
And that's a big deal. Series A is a fuel for brand new, groundbreaking ideas.
So if you throttle that back by a third, aren't we basically creating a huge innovation deficit for, say, 2029 or 2030?
That is the precise long-term risk. Fewer Series A deals today means fewer companies in the pipeline ready for an IPO in 3 to 5 years.
So the quality of who gets funded now is higher, but the pool is shrinking.
Unquestionably, only the best teams with the most defensible science are getting funded, but the overall pipeline is shrinking.
And with that traditional route so constrained, companies have been scrambling for other ways to get cash.
Yeah, alternative lifelines. And you see it in the deal terms. Valuations have normalized.
They're down a lot from those 2021 peaks.
30 to 40% lower, which is actually healthy. We're seeing deals done at, 6 to 8 times revenue, not the crazy 12 to 15 times we saw in the boom.
And who's stepping in with the cash?
Primarily big pharma. Strategic partnerships, out-licensing deals, they're up 18% year over year.
That makes sense. They have huge cash reserves.
And they're using it to co-invest or negotiate royalty deals. It provides crucial, non-dilutive capital for these smaller biotechs.
Smart money. They get access to new drugs without taking on all the risk.
Exactly. And beyond that, debt financing, like royalty-backed lending, has doubled. It's now, 12 to 15% of growth financing? They're essential lifelines.
So it's a picture of a market that's getting healthier, but it is, as you said, fiercely selective. Let's talk about the constraints, the enduring risks.
Right. We have to balance the optimism. We've covered the bull case. Macro normalization, regulatory clarity, AI savings, demographics, but you have to understand the bare risks.
And the first one is the very capital scarcity we were just talking about.
It's intense. The IPO bar is so high that good companies are forced to stay private longer, which just extends their cash burn. They need more rounds, more dilution.
And then there's the biggest risk of all in biotech, the science itself.
The unforgiving reality. Our sources confer it. Roughly 90% of drugs that enter clinical trials fail before they get approved.
90%.
Biology is unpredictable. You can have the best AI, the most capital, and a single clinical setback can wipe out years of investment instantly.
That failure rate ties directly to the next risk, which is that incredibly long profitability horizon.
It's daunting. We're talking an average of 12 to 15 years post-IPO to get to cash flow break-even. Investors are scrutinizing that timeline like never before.
Which again favors the big mature companies.
Of course. And finally, you have the external geopolitical risks. Supply chains.
Specifically, active pharmaceutical ingredients, or APIs. The stuff that actually makes the drug work.
And right now, China and India supply about 80% of it. Any major trade tension, any sanction,
And your manufacturing costs could spike overnight.
or your launch gets delayed. It introduces massive uncertainty. And you layer on top of that unpredictable changes in global drug pricing or reimbursement rules, and it's a powerful constraint on growth.
Okay, let's bring this all together and connect the story to the hard data. Let's chart the recovery.
The data really confirms the whole narrative. You look at a chart of capital raised, you see that sharp decline hit an inflection point right in Q3 2025.
Exactly when Billion to One and Silico priced their deals.
Exactly. The IPO count is still low, but the capital raised is reversing. And that VC chart showing Series A suppressed and Series C growing, I mean, that's the whole story right there.
And it's not just an internal story. The big ETFs like IBB and XBI, they've actually been outperforming the S&P 500 since October.
Yeah, the IBB returned something like 13.6% year-to-date in 2025. The market is noticing.
And from a technical standpoint, the chart looks healthy.
It does. The IBB has a clear uptrend from the March lows, higher highs, and we just saw a classic bull signal emerge.
The Golden Cross.
The 50-day moving average is now trading above the 200-day moving average. For your listeners, that just signals that the short-term momentum is building real strength over the long-term trend.
And where are the key levels to watch?
Well, support is building nicely around that $330 to $340 level. The real test, though, is the 2021 highs. That's up around $375 to $385.
Breaking through that would be a huge signal.
A huge signal that the market has really put the collapse behind it. And what's encouraging is that the volume spikes we saw in the fall coincided with institutional repositioning. This move is being driven by smart money, not just retail speculation.
So what's the big picture takeaway for you?
It's clear. The biotech capital market reopening is real. It's happening. But it is fiercely selective.
The era of spray and pray is over. The bar to go public has been permanently raised.
And the challenge now shifts to all those companies that raised money back in the 2020-2021 bubble. They have to prove their science can actually generate revenue. So for investors, it's all about fundamental selectivity. Management, science, and a clear path to commercial viability. Precision and patience, that's the new game.
Which leaves us with a final provocative thought for you to think about. If today's market is so rigorously rewarding maturity and proven execution, what does the current scarcity of Series A funding down 35% mean for the biotech pipeline 5 years from now?
Are we trading tomorrow's radical breakthroughs for today's stability? A really interesting question.
See you all in the next Pro Ticker Deep Dive.